Imagine waking up one morning and every single market on the planet stocks, oil, gold, currencies moves at the exact same moment, not because of an election, not because of a company earnings report, not because the Fed said something, but because of a narrow strip of water, 34 miles wide, sitting between Iran and Oman. In the middle of the Persian Gulf, a strip of water that most people couldn't find on a map. A strip of water that, for the past several weeks, has been holding the entire global economy hostage. Now imagine that chokehold suddenly releases. That is exactly what happened. The Strait of Hormuz has fully reopened, and markets didn't just react, they exploded. Oil dropped, stocks surged, billions of dollars moved in a matter of hours. And if you're watching this right now without understanding why, then you are missing one of the most important financial stories of the decade. Because this isn't just about oil, this isn't just about the Middle East. This is about how war, geography, and global money are all connected in ways that directly affect your cost of living, your investments, and the economic reality of every single person on this planet. So today on the John Mindset, we are going deep. We are going to talk about what the Strait of Hormuz actually is, why its closure shook the foundations of the global financial system, what the reopening means for markets right now, and most importantly, what smart people are watching next, because this story is far from over. Stay with me, this one matters. Let's start at the very beginning, because if you don't understand what this strait actually is, nothing else in this video will make sense. The Strait of Hormuz is a narrow waterway that connects the Persian Gulf to the Gulf of Oman and from there to the rest of the world's oceans. On one side you have Iran, on the other side you have the Way and Oman. The strait is only about 34 miles wide at its narrowest point, and the actual shipping lanes, the lanes where massive tankers carrying oil move through, are just 2 miles wide in each direction. 2 miles, that's it. That is the corridor through which roughly 20% of all the world's oil passes every single day, and we're not just talking about oil, about 21% of all liquefied natural gas traded globally moves through that same narrow passage. Add to that the fertilizers, the petrochemicals, the refined products. When you add it all up, you are looking at a waterway that handles somewhere between 20 and 25% of the world's total energy trade. Now let me put that in a number you can actually feel. We're talking about approximately 20 million barrels of oil passing through that strait every single day. Every single day. That's roughly the combined oil consumption of the United States, China, and India, the 3 largest economies on Earth, all flowing through a gap you could cross in a short boat ride. And here's the thing that makes this so uniquely dangerous from a financial perspective. There is no easy alternative. There is no backup plan that works at scale. There are pipelines that bypass the strait. Saudi Arabia has the East-West pipeline. The Way has the Habshan-Fujairah pipeline, but their combined capacity cannot come anywhere close to replacing what moves through Hormuz. If you shut that strait down, you cannot simply reroute the oil. You cannot snap your fingers and find another way. The global energy system was built around the assumption that Hormuz would always be open, and when it wasn't, the world found out very quickly and very painfully exactly how fragile that assumption was. This is why military strategists, economists, and geopolitical analysts have called the Strait of Hormuz the single most important choke point on the face of the earth. Not the most talked about, not the most famous, the most important. Because nothing, not the Panama Canal, not the Suez Canal, not any other waterway carries this kind of concentrated economic weight. If you control the Strait of Hormuz, you have your hand around the throat of the global economy, and for several terrifying weeks in early 2026, Iran did exactly that. Now, to understand why the reopening is such a massive deal, you have to understand how we got here, because this didn't happen overnight. This crisis was building for months, and the financial world watched it escalate with growing dread. Following the breakdown of nuclear negotiations in late 2025, tensions between the United States and Iran reached a boiling point. On February 28, 2026, the United States and its allies launched a coordinated military operation, what became known as Operation Epic Fury, targeting Iranian enrichment facilities and key command infrastructure. The strikes were precise and calculated, but their effect on global markets was anything but controlled. Within hours of the first reports, oil prices began to spike. Within days, Brent crude, the international benchmark, was climbing toward $100 a barrel, and within weeks it had blown past that level and was surging toward $120, a price not seen since the summer of 2022. But the oil price was just the beginning. On March 4, 2026, Iranian forces made a declaration that sent shockwaves from Wall Street to every commodity exchange on the planet. They declared the Strait of Hormuz closed to commercial traffic, not threatened, not warned, closed. Tanker insurers immediately withdrew coverage. Major oil companies halted transits. The commercial shipping world effectively froze, and the International Energy Agency, an organization not known for dramatic language, called it the largest supply disruption in the history of the global oil market. Let that sink in. Not the largest in recent memory, not the largest in a decade. In history. Brent crude closed above $100 a barrel on March 12th. By March 19th, it had spiked to $119. The S&P 500 fell 15% from its peak in a matter of weeks. US gas prices rose roughly 60 cents per gallon in just the 2 weeks following the start of the conflict, Bloomberg. Economics estimated March inflation at 3.4% year-over-year, up from 2.4% in February, a massive single-month jump. The Federal Reserve, which had already been expected to cut rates in 2026, suddenly found itself trapped. It could not cut rates in the face of surging energy-driven inflation, but it also could not raise them into a slowing economy. Futures markets, which had previously priced into rate cuts for the year, collapsed to pricing in zero, with a meaningful probability of no cuts at all in 2026. And it wasn't just the United States. The IMF, in its April 2026 World Economic Outlook, which it titled with rare bluntness "Global Economy in the Shadow of War," downgraded global growth to 3.1% for the year. Sub-Saharan Africa saw its median inflation projection jump from 3.4% to 5%. Emerging markets from South Asia to Southeast Asia faced a brutal combination of higher import bills, weaker currencies, and tightening financial conditions. Malaysia, a country that depends heavily on stable shipping routes, found itself dealing with existential supply chain disruptions. The fertilizer markets critical to food security globally were thrown into chaos because nearly 50% of global urea exports originate from countries west of the Strait and typically transit that route. Higher fertilizer costs mean higher food prices. Higher food prices mean more poverty, more hunger, more social unrest. The world spent roughly 6 weeks staring into a very dark abyss, and then slowly, painfully, diplomatically something shifted. The turning point came on April 7, 2026. A temporary ceasefire was brokered quietly, behind closed doors, to allow for humanitarian corridors and to create the conditions for serious diplomatic engagement. It wasn't announced with fanfare, there was no victory speech, but for the financial markets, the signal was unmistakable. Something was changing. Over the following days, high-level peace talks began in Islamabad, Pakistan. US Vice President J.D. Vance and Special Envoy Steve Witkoff led a delegation that was reportedly hammering out a potential 15-point peace framework with Iranian representatives. President Trump, who had escalated the situation aggressively through what was being called maximum pressure 2.0, signaled to his advisors that he was willing to pursue an endgame to find an off-ramp that would prevent a wider regional war and critically restore the flow of oil through Hormuz. Markets didn't wait for the official announcement, they never do. As soon as the signals of de-escalation began leaking into the financial press, capital started moving. WTI crude, which had been trading above $100, began sliding back toward $90 a barrel. The S&P 500 started reclaiming critical technical levels that it had lost during the March sell-off. Technology stocks, which had been hammered during the flight to safety, started leading a recovery. Goldman Sachs revised its oil price forecasts. JP Morgan began issuing more cautiously optimistic notes on emerging market assets. And then the Strait officially reopened. Oil tankers, which had been anchored offshore waiting for the signal, began making their way back through the passage. Iran confirmed that commercial shipping was free to transit. Insurers, hesitantly at first, began restoring coverage. The shipping community exhaled, and in the trading rooms of New York, London, Frankfurt, Tokyo, and Shanghai, the reaction was immediate and explosive. Oil fell sharply. Stocks surged across the board. The risk-on trade was back with a vengeance. As of mid-April, WTI crude had pulled back to approximately $91 a barrel, still elevated historically, but a dramatic decline from the crisis peaks. The S&P 500 had recovered much of what it lost in March. The risk-on sentiment that investors had abandoned during the worst of the crisis was returning with force. And underneath all of this, a fundamental question was beginning to take shape in the minds of serious investors and analysts around the world, not just what happened, but what comes next. Here is where it gets really interesting, and this is the part that most financial news coverage completely misses. Because when people hear markets exploded, they assume that simple good news happened. Stocks went up, end of story. But that's not how this works. What's happening in markets right now is far more complex, far more layered, and far more consequential than a simple relief rally. There are multiple rotations happening simultaneously, and each one tells you something important about where capital is flowing and why. The first and most obvious rotation is out of energy and defense and into technology and growth. During the height of the crisis, energy stocks were the clear winners. When oil is at $115 a barrel and climbing, companies like ExxonMobil and Chevron are printing money. Defense contractors Lockheed Martin, Northrop Grumman, Raytheon saw their order books swell and their stock prices surge as governments globally began accelerating military spending. But now, with the war premium fading, with oil retreating, with the prospect of a sustained peace framework emerging, those sectors are facing headwinds. The market is pricing in a world where the emergency defense spending cycle slows down and where energy companies no longer have a geopolitical tailwind underneath them. Meanwhile, technology is roaring back. NVIDIA, which had been sold off during the risk-off period, is seeing renewed institutional buying. Apple, Microsoft, the entire high-growth technology complex investors are piling back in with the logic that a stable Middle East removes a key headwind and gives the Federal Reserve more room to maneuver. If oil keeps falling, headline inflation cools. If headline inflation cools, the Fed can potentially cut rates later in the year. And if rates fall, growth stocks which are valued on future earnings discounted back to today become dramatically more attractive. This is the chain of logic that's driving the technology rally, and it's not irrational, it's actually quite coherent. The second major rotation is happening in bond markets, and it's more subtle but equally important. During the crisis, investors flooded into short-term cash instruments. Total money market fund assets reached a record $7.86 trillion, almost $8 trillion sitting in cash equivalents, earning safe returns, waiting for the dust to settle. As the situation stabilizes, that enormous pool of cash will start looking for a home. Some of it will go into equities, some of it will go into bonds, and some of it will flow into emerging markets and international assets that were beaten down during the crisis, assets that now look cheap relative to their fundamentals. The third rotation, and this one is particularly important for people watching from Pakistan, from South Asia, from the developing world, is the potential shift in capital flows toward emerging markets. During periods of geopolitical stress, the dollar strengthens as investors flee to safety, emerging market currencies weaken, their cost of imports rises, their debt burden, if denominated in dollars, becomes harder to service. But as the stress eases, as the dollar stops surging, capital starts flowing back into higher-yielding emerging market assets. Countries like India, Indonesia, Brazil, net energy importers that were hammered by the oil shock, are now potentially positioned to benefit from the reversal. The terms of trade improve as oil falls, currency pressure eases, and international investors, looking for returns in a world where the immediate crisis has passed, start shopping for value. But here is where the John mindset separates itself from the noise, because while every financial outlet is celebrating the reopening, while every headline is screaming about the market rally, there are serious risks sitting underneath this story that the mainstream narrative is almost entirely ignoring. And if you are an investor, if you are a business person, if you are anyone trying to make smart decisions about money in this environment, you need to understand these risks clearly. Risk number 1, the peace deal is not done yet, the ceasefire is fragile, the negotiations in Islamabad are ongoing, the 15-point framework is still being negotiated, and here is the brutal financial reality: any signs of Iranian non-compliance, any breakdown in the diplomatic process, any escalation from either side could send oil prices back above $100 in a matter of hours. Markets are currently pricing in a successful resolution. They are betting on the good outcome. And when markets are priced for perfection, the margin for error is zero. One bad headline, one military incident, one rejection of a key term in the peace framework, and the sell-off could be faster and more violent than anything we saw going into the crisis. Risk number 2, the structural damage is already done. Even if the strait stays open from this point forward, the months of disruption have left marks on the global economy that don't disappear overnight. Supply chains that were rerouted are not snapping back instantly. Business contracts that were restructured are not unwinding in a day. Investment decisions that were postponed are not being made immediately. The IMF made clear in its April 2026 report that conflicts generate large and persistent output losses that last well beyond the immediate wartime shock. The reopening of a shipping lane does not automatically undo 6 weeks of economic damage. The scars take time to heal, and during that healing period, there is real economic softness that the market may be underestimating. Risk number 3, the stagflation threat is not over. Yes, oil is coming down from its peak, but it is still significantly elevated compared to where it was before the conflict started. Energy costs that have already been embedded in supply chains, in transportation, in food production, in manufacturing, those costs don't disappear. The moment Hormuz reopens, they filter through the economy on a lag. That means inflation could remain sticky even as growth softens. And that is the Fed's nightmare scenario: stagflation, where you have too much inflation to cut rates and too little growth to raise them. Several Fed officials have already signaled that 7 of 19 FOMC participants expect rates to remain unchanged through the end of the year. That means the rate cuts that the market is now pricing back in may not arrive as quickly or as decisively as the optimistic scenario assumes. Risk number 4. The geopolitical architecture of the Middle East has permanently shifted. This conflict, regardless of how the diplomacy plays out, has revealed fault lines and created new alignments that will reshape the region's economic and political landscape for years. The reports of covert Chinese arms shipments to Iran during the conflict, the emergence of a potential new Sunni axis including Qatar, Saudi Arabia, Turkey and Pakistan, the questions around NATO's relevance and cohesion, the deepening of US-China strategic competition. The Hormuz crisis was not just a military event, it was a geopolitical earthquake, and the aftershocks are going to keep rippling through global markets long after the tankers start moving again. So given all of this, the rally, the risks, the rotations, the uncertainties, what should you actually be doing? What are the people who understand this situation watching most closely right now? First, they are watching oil, not as a commodity to trade, but as a signal. If WTI crude continues to fall toward $80 a barrel, it tells you the market believes the resolution is durable, that supply is normalizing, that the worst is behind us. If oil starts creeping back up, if it reclaims 95, if it approaches 100, it means something is going wrong in the diplomatic process, and every other asset class is going to reprice accordingly. Second, they are watching the Federal Reserve. The Fed's next move is now back in play in a way it wasn't during the crisis. Chair Powell and the committee are watching core inflation closely, the measure that strips out volatile food and energy prices, because if the energy shock hasn't fed through into broader price pressures, the disinflationary trend can resume. If core inflation stays contained, the path to rate cuts later in the year reopens. And if it does, that is enormously consequential for equities, for bonds, for currencies, and for emerging markets everywhere. Third, they are watching China, because China is not a passive observer in any of this. China imports more oil from the Persian Gulf than any other country on earth. The disruption of Hormuz hurt China badly, and China's response to this crisis, its covert support for Iran, its diplomatic positioning, its relationship with the Gulf States tells you a great deal about how the next chapter of US-China great power competition is going to unfold. The anticipated Trump-Xi summit, the semiconductor negotiations, the rare earth leverage that Beijing holds, all of these threads are woven together in a tapestry that is going to shape global trade and investment for the rest of this decade. Fourth, and most profoundly, they are watching the peace dividend, because here is the most extraordinary upside scenario that nobody is fully pricing in yet. If the Middle East genuinely stabilizes not just a ceasefire but a durable, sustained reduction in regional tensions, the amount of capital that gets unlocked is staggering. Defense budgets that were inflated by emergency spending start to normalize. Capital that was parked in cash and gold and energy starts flowing back into productive investments. The AI-driven technology boom, which was briefly overshadowed by the geopolitical crisis, reasserts itself as the dominant economic narrative. Emerging markets breathe, supply chains rationalize, and the global economy, which the IMF projected at 3.1% growth under the assumption of a short-lived conflict, could actually surprise to the upside if the resolution proves more durable than the base case assumes. That is the bull case, and it is real, it is plausible, but it requires things to go right in Islamabad, in Tehran, in Washington, and across a region that has a long and complicated history of peace agreements falling apart. Here is what I want you to take away from everything we've covered today. The reopening of the Strait of Hormuz is not just a geopolitical headline, it is a profound economic event with consequences that are going to ripple through your life, through your cost of fuel, your grocery bill, your investment returns, the job market, the interest rate on your mortgage for months and potentially years to come. The fact that markets exploded in response tells you something important. The world was holding its breath, and the relief of exhaling is real and powerful. But the smart money, the investors, the analysts, the strategists who have been doing this for decades, they are not simply celebrating the rally and moving on. They are asking harder questions. Is the peace durable? Is the inflation already baked in? Is the Fed trapped? What does China do next? What does a permanent shift in Middle Eastern geopolitics mean for global trade architecture? These are the questions that separate people who react to financial news from people who understand it. And the whole point of this channel, the entire reason the John Mindset exists, is to help you be in that second group, to help you look at the world the way it actually works, not the way the headlines tell you it works. The Strait of Hormuz is open again, 34 miles of water, and the world just breathed again. But keep your eyes open, because the game is still being played, and the people who understand the game are already 3 moves ahead. If this video gave you value, subscribe right now, because the follow-up to this story is coming fast and you do not want to miss it. Share this with one person who needs to understand what is actually happening in the world economy, and drop a comment below. I want to know, do you think this piece holds? Are you bullish or bearish from here? I'm your host on the John Mindset. Stay sharp, stay informed, and I'll see you in the next one.